So, you have a brilliant business idea. Maybe you want to open a coffee shop that only sells cold brew. Or perhaps you've created a revolutionary app that organizes your sock drawer. You've got the passion and drive. You've done your research. There's just one tiny problem. You need money. This is where the conversation about business loans begins. It's surrounded by mystery and misinformation. A loan is the key to growth. Buy inventory, rent a space, hire employees, launch a game-changing marketing campaign. Without initial capital, ideas stay trapped. Banking feels like an exclusive club. People think loans are nearly impossible unless you're rich or connected. They hear horror stories and read rejections online. Fear makes many give up before they start. But much of that is wrong. Banks make money by lending. They want businesses that will succeed and repay. It's about a promising future, not perfection. Let's start with the biggest, most intimidating myth of them all. The belief that you need a flawless 800+ credit score to even think about applying for a business loan. So many people count themselves out over a few old late payments. They picture a grumpy loan officer rejecting them instantly. This fear stops countless entrepreneurs dead in their tracks. They assume past mistakes permanently disqualify them, so they don't even try. The truth, a high credit score helps, but it's not the only factor. Think of your loan application as a puzzle. Your personal credit score is just one piece. They will also look at your business credit score, your annual revenue, your cash flow, how long you've been in business, the industry you're in. A strong business plan with solid financial projections can make up for a weak score. A lender might see a 650 score, but also rapidly growing monthly revenue, which shows repayment ability. Imagine two owners. Owner A, pristine 810 credit score, brand new business, zero revenue, vague business plan. Owner B, 670 credit score, operating 2 years, consistent monthly profits of $10,000, detailed plan to buy equipment to double production. The safer bet is owner B strong, predictable cash flow is the best proof you can give. Another huge myth that discourages new entrepreneurs is the idea that you have to be in business for 5 years, 10 years, even 20 years. People picture lenders wanting to see a long, storied history, decades of tax returns, a track record as old as the building the bank is in. This makes founders feel like they have no chance. They think, I've only been operating for a year, why would they give me a loan? This mindset is defeating and makes many believe funding is only for the big guys. In reality, a long history helps, but many lenders will work with younger businesses. The key isn't age, it's the health and potential of the business. Lenders care about your revenue and your cash flow. A 1-year-old profitable business with an upward trend is often more attractive than a 10-year-old business that's flat or declining. The lender isn't asking how old are you? They're asking how healthy are you and where are you going? They're investing in your future, not just your past. Many modern lenders and fintechs offer products for businesses operating 6 months to a year. Age is just a number. Cash flow is king. The word collateral can sound pretty scary. It's the central component of what's known as a secured loan. In simple terms, it's a safety net for the lender. To get a loan, you pledge a valuable asset you own. This gives the bank confidence because it reduces their financial risk. If you can't pay, they have a way to recover their losses. Think about the most common large loans. When you get a mortgage, the collateral is the house. If you finance a vehicle, the car is the collateral. For a business, this could be heavy machinery or valuable inventory. And here's the part that causes anxiety. If you default on the loan, the lender has the legal right to seize that asset. This is called foreclosure for a house, or repossession for a vehicle. They can then sell it to recoup their money. This is where a major myth takes root. Many modern entrepreneurs, especially those in service or digital businesses, don't have much traditional collateral. Think of a graphic designer, a consultant, or a software developer. Their biggest assets are their skills and client relationships. They might be working from a laptop at their kitchen table, running a lean, asset-light business. This reality often leads to a frustrating conclusion. I'm automatically ineligible for a loan. The internal monologue starts, my business is profitable, but I don't own a building. I have nothing tangible to offer as security, so no one will ever lend me money to grow. But here's the great news. That assumption is outdated. The world of business lending has evolved, thanks to fintech companies and new ways of analyzing business health. Lenders now have products for asset-light businesses. This has opened the door to loans that do not require specific collateral, known as unsecured business loans. So, if there's no collateral, what are lenders looking at? They shift their focus from what you to what you. Approval is based on the financial strength of your business, with a focus on cash flow. Lenders analyze your bank statements and sales history, looking for consistent deposits and a healthy balance. They're betting on your ability to generate revenue to handle payments. Of course, there is a trade-off. Because the lender takes on more risk, they compensate in other ways. You can expect a higher interest rate. Repayment terms might also be shorter. But the most important element is often a personal guarantee. This is a legal promise that if your business defaults, you are personally responsible for the debt. This means the lender could pursue your personal assets like your home or savings. So the myth that you must have collateral is busted. If you lack traditional assets, your path to funding isn't blocked, it just looks different. Focus on performance. Build a strong, documented track record of revenue and responsible cash management. Prepare your financials, understand your numbers, and confidently explore the world of unsecured loans. Don't let a lack of physical assets stop you from seeking the capital you need to grow. When people shop for loans, they often have tunnel vision. They focus on one single number, the interest rate. It makes sense, right? A lower interest rate means you pay less over the life of the loan. So the lowest rate must automatically be the best offer. Entrepreneurs will spend hours comparing lenders, trying to find 7.5% instead of 7.8%. They think that slight edge is the victory. This focus can make them overlook other important factors. Interest rate is only one part of the total cost. Look at the annual percentage rate, APR. APR includes interest plus additional fees, origination fees, closing costs, documentation fees. An 8% rate with a 4% origination fee can cost a lot more. It may be pricier than 9% with no fees. Always ask for the APR for a true side-by-side. Lowest interest can be a marketing trick to hide costs. Also consider the loan's terms, repayment period. The best loan fits your business's needs, not just the lowest number on paper. Thanks to slick commercials for personal loans and mortgages, many people have a skewed perception of the loan application process. This constant exposure, especially from the booming fintech industry, has conditioned us to see borrowing as a simple transaction, creating a false equivalence with the world of business financing. We see ads showing someone tapping a few buttons on their phone and getting instantly approved for thousands of dollars. The message is clear. Money is easy. It's natural for a hopeful entrepreneur to believe applying for a business loan will be a similarly quick and painless experience. This belief system leads them to envision a simple one-page online form. They picture themselves confidently clicking submit and then waiting for the money to magically appear in their business bank account within a day or two with no further questions asked. But this vision of instant funding is a mirage. When entrepreneurs armed with this false confidence begin the actual process, the collision with reality can be jarring. This expectation sets them up for immense frustration and disappointment, sometimes even causing them to abandon their search for funding altogether. The truth is, applying for a business loan is a fundamentally different, more involved and document-heavy process. Why the massive difference? It all comes down to risk. Lenders must perform thorough due diligence to understand the health and future viability of your business. With a personal loan, a lender bets on your individual ability to repay based on credit history and income. But with a business loan, they are investing in a complex organism, your company. They aren't just evaluating you, they're evaluating your market, team, operations, and financial management. This deep level of scrutiny translates directly into paperwork. You'll need to provide documents that tell your company's complete financial story. This generally includes multiple years of business and personal tax returns to prove profitability and compliance. You'll also need recent profit and loss statements to show current performance, and balance sheets to detail your overall financial health. Finally, several months of business bank statements are crucial to demonstrate your real-world cash flow and daily money management. But financial history is only half the story. On top of these backward-looking documents, you will need a forward-looking one, a comprehensive business plan. This isn't a simple description of what your business does. It's a detailed roadmap. A proper business plan must include a market analysis of your industry and competitors, details on your management team, your marketing and sales strategies, and most importantly, detailed financial projections. These projections are your promise to the lender, showing exactly how you plan to use the loan and how the business will generate the future income to pay it back. Creating this document is a significant undertaking that requires time, research, and careful strategic thought. It's a marathon, not a sprint, but it's a race you must run to get to the funding finish line. There are few things more discouraging for an entrepreneur than receiving a loan denial letter. After all the hard work of gathering documents, perfecting your business plan, and waiting anxiously, a no can feel like a final judgment on your business and your dream. Many people take this rejection personally. They assume it means their business idea is bad. They assume they aren't cut out to be an entrepreneur. They assume no other lender will ever give them a chance. They get so disheartened that they simply give up on seeking funding, thinking that if one bank said no, they all will. This is a huge and costly mistake. The reality? A loan denial is not a dead end. It's a data point. Lenders are required by law to provide you with a reason for the denial. This isn't just a formality, it's valuable feedback you can use to your advantage. The denial letter will explicitly state why your application was not approved. Common reason? Insufficient cash flow. Common reason? A high debt-to-income ratio. Common reason? A low credit score. Common reason? Being too new of a business. This isn't a rejection of your entire business, it's a specific critique of parts of your financial profile. A denial is essentially a free roadmap from the lender. Use the denial as a learning experience. Work on strengthening the weak points in your application. Persistence is key. So, we've smashed the myths. Now let's talk about what you should actually be doing to prepare for a successful loan application. It's not about secret handshakes or knowing the right people. It's about building a foundation of trust and demonstrating your business's viability in a clear, undeniable way. The key is to think like a lender. A lender is trying to answer one fundamental question. If I give this business money, what is the probability that I will get it back with interest? To do this, they assess your application through a time-tested lens, often called the 5 C's of credit: character, capacity, capital, collateral, and conditions. Character is your financial track record. Capacity is your ability to repay the loan from cash flow. Capital is the personal investment you've made, showing you have skin in the game. Collateral is any asset you pledge to secure the loan. And conditions are the loan's purpose and the broader economic environment. Everything you do in your preparation should be aimed at providing compelling evidence for each of those 5 C's, making their decision not just easy, but obvious. This process starts long before you ever fill out an application. It starts with getting your financial house in order and building a professional foundation. This means establishing your business as a legitimate, separate entity with the proper legal structure, like an LLC or corporation, and obtaining all necessary licenses. It signals to lenders that you're serious and have moved beyond the hobbyist stage. First and foremost, open a dedicated business bank account and run every single dollar of business income and expenses through it. Do not mix your personal and business finances. This isn't just a suggestion, it's a non-negotiable first step. Commingling funds is a huge red flag for lenders because it makes it impossible to accurately assess your business's true financial performance. It muddies the waters and raises legal questions. A separate account is the bedrock of financial clarity. Lenders will want to see at least 6 months and often up to 2 years of business bank statements. When they look at these statements, they want to see a clear, easy-to-understand story of your revenue and expenses. This story is your business's financial biography written in transactions. Is it a story of consistent growth or a tale of erratic cash flow? They will look at your average daily balance. This demonstrates your cash cushion. They will look at the number and consistency of deposits, which shows the health of your sales pipeline. And they will absolutely look at any negative balance days or overdrafts. These are major warning signs that suggest poor financial management and signal a high risk of default. A clean, consistent set of bank statements is one of the most powerful tools you have for proving your business's health and directly supports the capacity C of credit. Next, get your bookkeeping in order and keep it updated. This means having current and accurate financial statements. Think of these as your business's report card. Your profit and loss statement shows your profitability. Your balance sheet is a snapshot of what you own versus what you owe, and the statement of cash flows tracks the actual movement of cash. Together, these documents paint a complete picture of your financial health. When a lender asks for your financials, you want to be able to provide them immediately. Having these documents ready isn't just about speed, it's about confidence. It tells the lender that you understand the language of business. You're not just a passionate creator, you're a savvy operator who respects the numbers. This builds immense trust, making you a much more attractive borrower. Navigating the world of business loans can seem daunting, but it doesn't have to be an impossible journey. As we've seen, many of the biggest fears and beliefs that hold entrepreneurs back are simply myths. You don't need a perfect credit score. You don't need to have been in business for a decade. You don't always need to pledge your house as collateral. The lending landscape is more diverse and accessible than ever before. The secret isn't about fitting into some perfect imaginary box. It's about understanding what lenders truly value and preparing yourself accordingly. Lenders care about risk and return. They want to see that you run a healthy business. They want to see that you have a clear plan for growth. They want to see that you have the cash flow to support your debt obligations. Present a clear, compelling, and data-backed story that makes lenders feel confident in your ability to succeed. This means meticulous record-keeping, a strong business plan, a deep understanding of your own financials. These habits make you a better business owner. The discipline for a loan application is the same discipline to run a successful company. Don't let fear or misinformation stop you from pursuing capital. The funding is out there. Your business dream is worth the effort.